G'day, taxpayers. Pop. The housing market and house prices in particular are starting to kick higher. It was evident a little while ago that pessimism I had at the start of the year that house prices would probably ease off a bit as unemployment rose was wrong. And not only are they not falling, they're actually increasing at a faster pace. So the rate of acceleration is really picking up. And that's from the Cotality Price indicator, which on monthly terms has increased from around about 0.5 to 0.6 to 0.7. Early signs for September are that it's going to be about 1%. So it's even accelerating further. And certainly the reason for that seems to be linked to the fact that immigration's been higher than we were assuming at the start of the year as well. The labour market's been more resilient than was thought to be the case at the start of the year. And importantly, new listings are 20% lower than the 5-year average. So if you're looking for a house, they're hard to find. There aren't that many for sale. And that's certainly seeing buyers come back and being reflected in auction clearance rates in the two big cities where auction clearance rates are probably a bit more relevant than the other cities, into the 70-75% region mark. And that's a consistent number for the last few weeks and indeed consistent with rising house prices. So for the here and now, it looks as if the housing market's really getting a kick along. And I wouldn't be at all surprised now to see that if the labour market remains resilient, that we don't get an unemployment rate much above 4.5% in this cycle, that's an important caveat, that we could see house price growth really kicking higher through the course of the next 6 to 12 months. And by that I mean, 10% price increases in the major cities. And with Melbourne catching up rapidly, having been the laggard for the last, 5 years or so. So interesting times. Does it impact the RBA? At the margin, it does look at the wealth effect and people get richer from appreciating house prices and it feeds into higher consumption. The RBA do look at that. They don't target house prices, of course, but they do look at it from a wealth effect, like any other asset. So if the stock market's very strong and people are feeling rich and they go out and spend, of course, that's a stimulatory issue for the economy. But for the here and now, maybe it's over to some of the other regulators to sort of put a bit of a clamp on borrowing limits. That could be something that cools the market down, particularly as the RBA is going to continue to cut interest rates because inflation is very low and the rate of economic growth is moderate at best. But housing, looking good.